Boom! What's going on, Investomaniacs? Your boy Knight Rider here. Today we've got a little Roku, a little Disney, and a little bit of Netflix going on for you. Up first, we've got Roku. Roku reported a great Q1, their most recent quarter, where their results exceeded their projections for revenue, gross profit, and adjusted EBITDA, which was due to strong operational execution, robust active account growth, and the ever-increasing shift to streaming. Roku estimates Roku TVs sold accounted for more than 1/3 of all smart TVs sold in the United States. Oh, that's so beautiful as a Roku investor. Roku also is seeing a jump in their standalone Roku devices, saying, quote, Q1 player unit sales were up 21% year over year. Our strategy of offering players at appealing prices. Roku also noted, and you can see these are quite affordable, starting as cheap as $30. Roku also noted how Q1 monetized video ad impressions across the platform more than doubled, and they expect this trend to continue throughout the rest of the year. Roku is benefiting immensely from some key popular trends right now. First, more and more content publishers are edging away from linear TV and more towards streaming. American satellite and cable companies lost over 3 million subscribers last year, and then lost another 1 million in just the first quarter of this year. That's why we're seeing accelerating growth in revenue. Then, because it's an accelerating rate at which people are leaving the old school TV. Hey, I've told you this, guys, before. With my apartment complex, I am literally forced to pay for cable. I have it. I have never once used it, ever. I still am using my Roku. Now, we then have giant companies like AT&T, Viacom, Comcast, Disney, Apple, and others who are creating their own streaming services while spending billions of dollars to create and license out original content. This may scare off some investors, but it shouldn't, because it may be bad for them as a group, having a lot more competition. Maybe it's not so good for Netflix, but this is a good thing for Roku, because Roku benefits from all the companies creating their own streaming services, as Roku is a platform. Roku is where these other streaming services will put their content on. It's kind of like the App Store for Apple, right? They want a bunch of companies competing and putting on new apps onto their App Store. Roku provides the software for TVs so they can play all these other streaming services. Right now, that's internal software, but they also provide, as we showed you, the Roku standalone players, which are the physical hardware which can turn a dumb TV into a smart TV capable of playing Disney Plus and Netflix and CBS All Access. And by the way, every single time they subscribe to one of those new over-the-top packages, if they subscribe on Roku, Roku gets a cut of that. So every time you hear about a company creating their own streaming service, maybe also think of Roku, because when there's so much buzz about Disney Plus right now, Roku is also going to be a winner of that. Disney Plus, they don't have their own little TV thing, right? You got to play Disney Plus on something. Now, of course, you can play it on your phones and tablets and whatnot. And that's not really going to help out Roku. But when you're watching it on a TV, and you're playing it through a smart TV device or something like a Roku, that is where Roku is going to benefit. And a lot of people still watch TV on actual TVs, not on computer monitors or tablets or things of that nature. Having said that, Roku's stock has roughly quadrupled in less than a year. Now, I own Roku, and I plan on being in the position for a while. I'm not intending on selling it anytime soon, even though the stock has ran up quite a bit. So I'm not so concerned if the stock comes down a little bit here. it may have moved up a little bit too fast. I don't necessarily think it's overvalued, but just stocks do have a tendency to come down a bit, to pull back a bit once they've ran so much. So this is probably a little bit more of a risky time than just a couple months ago when I was talking to you in terms of purchasing Roku. So this may not be the best time for you to get in and to initiate a position, particularly if you really want to bang, say in like the next year or 6 months or something like that. There's probably a little bit more downside in the short term than there was previously. But if you're thinking long term, then I still like the stock. Now let's talk Disney. Last month, they came out. That's not what it's supposed to be. There we go. Last month, Disney came out to an arrangement with Comcast to buy them out of their 33.33% share of Hulu. When asked about the implications of this purchase, Bob Iger stated, quote, "It'll give us the ability to bundle, which is a big deal, and share data. Advertising, or ad sales, is another benefit of all of this because we will integrate it with our ad sales across our other platforms. This gives us a great opportunity in terms of leveraging our content and our content creation engines, in this particular case, Fox, FX, ABC News, etc." Disney purchased Comcast's share of Hulu at a $27.5 billion valuation in 2024 dollars, or fair market value, whichever is higher. So, hey, I like Hulu, so it is possible they may actually end up paying a little bit more, but that would still be a good thing because that means the platform's doing really, really well and Disney owns it. Additionally, Disney is planning to release Disney Plus in mid-November. According to an analyst at UBS, it was found that public interest in Disney Plus is even higher than expected, which Disney says is great considering their marketing for Disney Plus hasn't even hit its peak yet. UBS surveyed 2,000 customers in the United States aged 18 and above between April and May and found that 43% were interested in Disney Plus even before the rollout on November 12th. This compares to Disney expectations of 20 to 30 million US subscribers by 2024, which may be a little bit less than the current interest in Disney Plus indicates. Remember, the amount of popular IP Disney has is absolutely staggering. All the way from Star Wars to Marvel to Pixar, and Disney will be pulling the majority of their content from other platforms, mostly Netflix. And also, this isn't just limited to Disney. Many providers are in the process of pulling their content from platform in attempt to create their own streaming service. While I think Netflix will continue to grow, I think the glory days for the stock being this ultra growth engine are coming to an end. I'm not necessarily saying today, but I do believe it is coming to an end. Once a solid chunk of content is pulled, you have to remember they have long-term agreements with these things, so it's going to be pulled kind of over time. But once a solid chunk from the various providers is pulled, and there's also going to be a lot more competition, I don't think that Netflix will be able to grow nearly as quickly. Additionally, there's going to be a lot more, and right, why can't it grow quickly? For two reasons. One being it doesn't have as compelling as a reason to join because it's not going to have as much high quality content. Yes, Netflix is creating their own content, but even today, it's still, listen, dude, I'm a huge Black Mirror fan, right? So, there are things on Netflix that I'm like, I totally love it, but let's be honest, it does not compare to some of the best IP out there, period, which is not owned by Netflix. And the amount of really high quality content that Netflix has is still relatively small. So they're going to have less high quality content, and they're going to have a lot, consumers are also going to have a lot more options. Now, of course, a lot of the people running these companies say it doesn't have to be a this or that type of a competition. People can have multiple streaming services, and I do believe people will have multiple streaming services. But it is possible in the future, going 5-10 years forward, Disney may not necessarily be one of the default options. Hulu, Disney Plus, you're gonna most people have Amazon Video already. Some people, I don't know how HBO is going to do now that they don't have Game of Thrones, although they are making a prequel, which I'll tell you, if I was running HBO, I'd do that exact same thing. I'm like, okay, how can I keep this Game of Thrones thing going? Let's make a prequel, because that's exactly what I do. So I think that's probably the right move. Oh, and remember, Amazon is making a big move with their Lord of the Rings thing that they're doing. So that's a huge investment on Amazon's side, and I think that's really going to put them in a new class, where right now Amazon is still, but granted, you don't pay anything. It's basically free. So you can't really complain that much, because it's not as high quality as like Netflix and Hulu and stuff. You get it essentially for free. But boy, they're investing so much money into that Lord of the Rings series that when that comes out, I think that could be a game changer. I think that could be kind of like a Harry Potter, Star Wars type level, and there's a lot of excitement about the new Star Wars shows coming out on Disney Plus. So I think there's going to be a lot more competition, and it is possible that even if people are getting 2, maybe 3 services, it is possible that there is a percentage of people who won't choose Netflix as one of those services, which is not something I said about a year ago. I'm like, hey, I think Netflix is it, but I just see more and more competition coming, and I see more and more content contracted to be pulled from Netflix, and I go, I'm not so confident anymore. Additionally, there will be much more supply on the investing side. Remember, it's a supply and demand thing, both on the consumer side, but also the investing side. In the past, if you wanted to directly invest in streaming, you basically had to invest in Netflix, right? Or something like Roku, right? But going forward, there's going to be Disney alone is going to have ESPN Plus, Hulu, and Disney Plus. That's 3 different services from one single company. So when you really think about it, if you fast forward 10 years from now, it's possible that Disney might be considered a better streaming play than Netflix is. Because you're going to have Disney Plus and Hulu, and those 2 things could end up being quite huge. CBS now has CBS All Access, and they're making some original content specifically for CBS All Access, like the new Twilight Zone series, which kind of annoys me that they don't. That's like the only thing I want to watch on CBS, and I'm not going to get the stupid app for that one single show, but they don't even play it on CBS. I'm like, I have cable. This is the one thing I would actually watch on cable. I like the Twilight Zone, but they're like, no, we're just going to make it for our app and not put it on our actual TV channel. But I see why they're doing that, right? They're, of course, trying to get people to subscribe to their service. That's more competition for Netflix, and Comcast will also be creating their own streaming service down the line. Thus, investors will be split between the various stocks, which means less money going into Netflix. All investors aren't going to have to pummel 100% of their money they want invested into this space into Netflix. So that's good for everybody else, bad for Netflix. Netflix has been pouring a massive amount of money into local language content in order to drive global subscriber growth, which of course is where the majority of their growth is coming from nowadays. When asked about competing with Netflix on this global local scale, Bob Iger, remember that's the CEO of Disney, replied, quote, "The advantage that we have, particularly on the Disney Plus side, is if you look at Marvel and Star Wars and Disney and Pixar and even National Geographic, there is global appeal to those products. There is a universal universe to that, whatever word I'm looking for. There is global interest in those. And so we probably will be able to rely on those much more. I haven't really studied just to what extent Netflix product travels globally. I'm sure there's some that does, but we will have more product that will travel successfully in markets around the world as a percentage of our total product than they will." Whew! That's a nice little quote. And coming from Bob Iger, that's a little bit spicy. Like, we'll have more stuff that travels globally than Netflix will. That's a little hair of spice on there coming from a guy like Bob Iger, because he's a pretty reserved dude. Yeah, look at that good-looking dude right there. Disney has one major goal in mind: strengthening their direct-to-consumer base. They feel as though once everything is working together, they'll be able to create not only more wealth for themselves, but hey, also investors. That's you. As well as more affordable content with the ability to package their services, and better quality content for the customer, because they will now have the direct information of what that customer is interested in, right? That's one of the benefits Netflix has. They know what you watch, so obviously they can recommend things that are relative to what you are interested in. Iger stated, quote, "So if somebody has bought Disney Plus and they've indicated they're a huge Star Wars fan, we may be able to figure out how to give them discounts on buying Star Wars goods or a visit to Galaxy's Edge at Disneyland or Disney World, those sorts of things." It sounds like it's just extra marketing, but we think we can create more value for the customer too. I am a big fan of Disney. I think it's very fairly valued, and I say it's a buy. I still like Roku, although I do think at this exact moment, there's a higher probability for a further stock pullback, although it has already actually pulled back a decent amount the past 2 weeks. But understand, with as much as it ran up in the past 7 or whatever months, there's a little bit more risk involved in that. With Netflix, I probably prefer that less than Roku and less than Disney right now. So maybe I don't exactly have like a buy or a hold on Netflix. I still like it. I think it's a solid company. I just don't think it's the best option out there for growth investors, and I certainly don't think it's where you would want to put your money as a value investor. Obviously, if you're a little bit more on the value side, I think Disney is really the way to go, because you get that value. It's very fairly valued, and yet I think you have a lot of potential for growth kind of in the far years. So anyway, guys, I appreciate all the likes, comments, and subscribes. Thank you, and may the market be with you.